Welcome back to this week's market update. Today is Monday, September 8th, 2025, and we will jump right in. It was an important week for jobs data with signs of continued softening in the labor market. Even so, stocks held firm as investors looked ahead to a likely rate cut next week, actually. In the shortened week, 2 out of 3 of the major U.S. indexes advanced, with the Nasdaq Composite up more than 1%, S&P 500 up about 1/3%, and then the Dow Jones Industrial Average falling about 1/3% last week. Heading into last week's economic data, the most recent jobs report showed this continuing weakness in the labor market, as we briefly mentioned there. Non-farm payrolls came in at just 22,000 new jobs added in the month of August, which is less than 1/3 of what was expected, at about 75,000 jobs expected in the month. Job gains in healthcare were partially offset by losses in federal government employment, as well as in mining, quarrying, and oil and gas extraction, while most other industries saw little change. The unemployment rate ticked up to 4.3% here in August, the highest level since 2021. We also saw average hourly earnings rise 0.3% for the month, up 3.7% from a year ago. So we are seeing some real wage growth for households on that metric. And then lastly, the average work week held steady at 34.2 hours for the third consecutive month. So overall, we did see markets kind of interpret this as evidence of a softer labor market, which has contributed to the expectations of a rate cut at the Fed meeting next week. Moving into some other economic data from last week, we did get both the ISM manufacturing and services indexes. The manufacturing index came in at 48.7% for the month of August, so up slightly from July, but still in contractionary territory. Within the index, we saw new orders actually rise above that 50 level for the first time in 6 months. However, we saw weakness in a lot of other areas. So production, employment, inventories, prices continue to be pretty hot here, well above the 50% neutral level, and then continued weakness in exports and imports based on a lot of trade uncertainty. So overall, the manufacturing sector is slightly better than July, but continues to be below 50 into this bearish territory. On the other hand, the services sector expanded for the third consecutive month in August, with the PMI coming in at 52%. So you can see we were near that neutral level in July, rising pretty sharply in the month of August there. And this was due to strength in business activities. We had a rise in new orders. Employment continues to be fairly weak, supplier deliveries pretty stable there, and prices continue to be pretty high as well. So overall, though, the services sector continues to be a source of strength, while the manufacturing sector continues to be pretty sluggish. Last but not least, taking a quick look at the state of several economic indicators, and then also taking a look at the state of monetary and fiscal policy as we look ahead to a potential rate cut next week. Starting off with the recession indicators here, you can see we have 5 negative indicators, 2 neutral, and then 1 bullish here. Overall, tilting pretty bearish. However, when you look through a little bit further, with the services being still bullish, this is a really good sign, as so much of the US economy is made up of services. So that being bullish is really positive for economic stability. We also have neutral readings in both the business outlook surveys and the employment trends indexes as well. So that's definitely supporting the stability of the US economy. And then last but not least, we have the anxious index, which continues to be bearish. However, as we can see here, it is actually at 22.8%. And this is simply just the risk of a negative quarter in the next quarter. Previously, it was at 36.1%, now dropping to just shy of 23%. So still historically elevated, which is why it came in as a bearish indicator, but it has been improving. You can see even for the fourth quarter, this fell as well, although we do get it creeping up a little bit in 2026. So overall, within these economic indicators, we do tilt bearish, but there are still some signs of stability and growth for sure. Finally, looking at monetary and fiscal policy here, purely from an economic perspective on the fiscal policy side, more tax policy certainty has been a good thing for the US economy, with a lot of tax rates expiring at the end of this tax year. So, certainty tends to be a positive thing for the market. Tariff impacts are still pretty much unknown, and they do come typically with a lag. So the net impact of tariffs is yet to be seen. We have seen a little bit of a rise in inflation as well as slowing in global trade, but the overall deeper impacts of tariffs have yet to be seen. And then lastly, lower government spending. This tends to be a restrictive force in the short term for economic growth. On the monetary policy side, it is still pretty restrictive with the Fed funds rate at 4.25 to 4.5%, at least for the last 2, 3 decades of recent history. But we are moving towards a more accommodative stance. So here you can see the probabilities for next week's Fed meeting sits at about 88.2% chance of a Fed rate cut coming next week. So that I would say is pretty solid expectations for a cut next week. We had the weaker than expected jobs report, as we talked about earlier in this video here. So that certainly has contributed to the need to cut rates here at this higher probability here. Overall, though, we have a lot of uncertainty still in the market, some indicators positive, some indicators negative, and we'll continue to watch and monitor as we always do. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.